Hi, thank you for joining us and welcome to this installment of David W. Klossing's Clarifying Tax Situations.
What's at stake when you're out of compliance with worldwide income and information reporting? That's the subject of this series. The first thing I need you to understand is that if you're out of compliance with worldwide information and income tax reporting as a U.S. taxpayer, you could potentially be looking at a very explosive situation. Unfortunately, the following fact pattern has been found sufficient in case law to criminally prosecute previous taxpayers that have found themselves in this situation. A combination of 3 badges of fraud, when added together, is sufficient to sustain a criminal prosecution for income tax evasion and willful non-filing of foreign bank account reporting forms, TDF 90-22.1, which went on to become FinCEN Form 114. The only change between the two is one is done in electronic format online, the other was in paper. First factor out of the 3 is non-filed FBARs, or FinCEN Form 114s. This form is required anytime you have greater than $10,000 on deposit in a foreign account in any combination of account balances. You take the accumulation of every account balance you have offshore, you add them together. If that's over $10,000, you have to complete this form. This form by itself is kind of innocuous. They'll hit you with a $10,000 penalty if you don't complete this form. The second factor in this trio of factors, or badges of fraud, that'll get you in trouble, is you have some sort of non-reported foreign income along with the non-filed FBARs. It starts to look like you're not telling the U.S. government about the foreign accounts because you're trying to hide the fact you've got these non-disclosed sources of foreign income that you're not reporting for income tax purposes. This starts to look like a conspiracy or an attempt to evade taxes to the U.S. government. The non-filed foreign income tends to come from investments in foreign markets, stocks, bonds, mutual funds, capital gains, ordinary income from interest, dividends, that sort of thing. Or it could be an offshore investment of some type, like real estate assets. It could look like you went out and bought a bunch of rental real estate in Switzerland right next to a ski resort, and you're not reporting the rental income off of that rental property, combined with not telling the U.S. government about the fact you've got an account that you're depositing all these profits in offshore that went above $10,000. It could also look like you went out and started a foreign business where you're running a full-on offshore business and you haven't complied with any of the foreign information reporting concerning starting that business, funding that business, whether you're dealing with a controlled foreign corporation, non-controlled foreign corporation, any type of offshore trust formation. All of this offshore activity, if it's generating taxable income in the United States that's not being reported for U.S. tax purposes, coupled with non-filed FBARs, that starts to look like a very dangerous fact pattern. What you also need to know in this area is that there's a set of regulations called the PFIC regulations, Passive Foreign Investment Company regulations. In my opinion, these regulations were created for one purpose and one purpose only: to make the record-keeping requirements on an offshore mutual fund so onerous that nobody in their right mind would invest funds offshore in a mutual fund. That the compliance headaches would make you invest in US-based mutual funds, which is really where they want your money anyways. There are 2 types of offshore investment activities in foreign businesses that need to be reported. You basically have a controlled foreign corporation regimen where if you own 51% or more of an offshore corporation, or you own that through related parties and you're up above 51%, that's considered a controlled foreign corporation. You're going to have to file a Form 5471 for information reporting purposes, and that's how that income is brought onto your U.S. domestic return each year, is through a 5471. If 5472 is required if you have a U.S.-based corporation that has greater than 25% foreign ownership. This is another way you can find yourself tripping on these offshore reporting regulations. Certain transfers of property to offshore corporations trigger a Form 926 tax filing, where you have to report the transfer of an asset to an offshore entity. there's a Form 8865 for reporting an investment in a foreign partnership. Any type of foreign real estate is reportable for U.S. tax purposes. This includes the renting of that real estate, the rental income has to be picked up, or the buying, selling, developing of offshore real estate. Anytime there's a realization event, as if it would have happened on U.S. soil, it's very similar to if it happened on foreign soil. As a U.S. taxpayer, you're taxed on your worldwide income. Doesn't matter where you make money, anywhere in the world, if you make money, it's reportable on your U.S. tax return. The U.S. is only amongst a handful of nations that do this, and therefore, if you're a recent immigrant to this country, that explains a lot if you're not in compliance with the law. Income from foreign retirement plans is reportable for U.S. tax purposes. Even though you earned all of that retirement pay offshore and then immigrated to the U.S., that income is reportable for U.S. tax purposes. If you have offshore sources of retirement income that you're not reporting for U.S. purposes, and you're accumulating that in an offshore account, and that account goes above $10,000, you don't tell them about the account, you don't tell them about the income, it starts to look like fraud. Offshore sources of income similar to U.S. Social Security may be taxable depending on the treaty between the foreign country and the United States. Also might look like fraud if you're accumulating that in an offshore account, not telling the U.S. government. One fact pattern I've seen over and over again in this area that's gotten a lot of people in trouble is foreign inheritances. I'll get more into that later, but basically a foreign inheritance can be non-taxable in the U.S. if it's handled correctly. A lot of people are not telling the U.S. government about foreign inheritance, thinking they're going to be hit with an estate tax they probably wouldn't have been hit with in the first place. And then they hide the existence of the offshore assets, the offshore accounts, the offshore income, because they're trying not to get hit with an estate tax. This will wind up in income tax evasion and foreign reporting fraud, which is a crime. The third badge of fraud that has been used to create a criminal prosecution is there's a checkbox on Schedule B where you report your income and your dividends. If you don't report the income on Schedule B from a foreign account, that's one badge of fraud. The second badge of fraud is there's a checkbox on Schedule B that says, do you have a foreign account, yes or no? If you answer no to that and you really have a foreign account, that's a badge of fraud. If you answer yes to that question, you're supposed to include a TDF 90-22.1, an FBAR, and tell them on that line where that foreign account is, what country it's in. If you don't do that, that's another badge of fraud. In recent years, there's an additional badge of fraud that may appear in your fact pattern. There's Form 8938, which is a FACTA filing required form. Anytime you have financial assets offshore greater than $50,000 in aggregate, you're supposed to fill out that form. If that's missing and you have more than $50,000 in aggregate assets offshore, that's another badge of fraud. The 8938 is the Statement of Foreign Financial Assets. Let me give you a quick history of how this issue became on the forefront of the tax authorities, both the civil and the criminal sides of the IRS, as of recent years. About 6 years ago, there was an employee of UBS that was about to lose a job. He said he couldn't afford to be without income, so he stuck a flash drive in a computer. He downloaded 50,000 of the highest account balances that U.S. taxpayers had in a Swiss bank called UBS and sold it to the U.S. government for several $1 million. This led to an eye-opening experience that the wealthy were having offshore deposits that were invested in foreign markets, and they were making their capital gains and their dividends and their interest and their stock splits and all sources of way in their margin trading. Any way you can make money in the U.S. domestic stock market, they were making their money in an offshore stock market and not reporting it for U.S. tax purposes. Through that investigation, it came to light that many banks around the world in tax haven countries, Switzerland being the #1 tax haven country at the time, were telling taxpayers all over the world, put your money in Switzerland. The entire world won't know it's here. We'll never tell them. Our Swiss bank laws prevent us from telling your government that your money's here. You can put your money in our stock market and you won't have to pay tax on your money that's making you money because we're not going to tell anybody about it. This was fostering income tax evasion on a worldwide scale, and Switzerland was not the only tax haven country doing it. In my opinion, what happened is the IRS, upon recognizing this was happening, went to Congress and said, give me the most draconian set of civil and criminal liabilities known to man so that I can force people to fix this problem if they have it. There were lots of laws on the books already that would punish this type of behavior. 7201 tax evasion. You had filing a false tax return under 72061. Failure to file a tax return under 7203. Willful failure to file an FBAR under USC 31, Section 5322. Conspiracy to defraud the U.S. under 18 USC Sections 286 and 371. The combination of all these criminal sections that I just described can earn you anywhere from 3 to 10 years in prison up to a $500,000 fine. Amongst other things the government could do to you, if they deemed your non-filing of the FBAR to be willful, they can hit you with the greater of 50% of the account balance or $100,000. There is some case law that says they could hit you for this 50% penalty for 5 years consecutively, which is 250% of the offshore account balance. In recent years, the government has tamped this down a little bit and said in no circumstances should it exceed 100% of your offshore account balance. What you need to realize is this the high water mark of your offshore account balance during the 6-year exposure period. There's a 6-year statute of limitations for tax crimes surrounding the FBAR. So if at one point your account balance was worth $3 million, but today it's worth $50,000, they could get you for $3 million, not $50,000. There's also civil penalties surrounding all of those foreign information reporting forms I was mentioning earlier. Most of them are about $10,000 per year for not filing one of those forms. If you have offshore businesses, a multiple of these form reportings could be due in any one tax year. The government also has at its disposal a civil fraud penalty. In other words, if it's deemed that you underpaid your tax liability by $1,000, but fraud is the reason you did that, you could be looking at $1,750. Here's a situation I've seen my clients trip on time and time again. If you have a foreign inheritance or you receive foreign gifts that exceed $100,000 in any one tax year, a Form 3520 becomes required. If you fail to file this form, a penalty of anywhere from 25% to 35% of the taxable gifts or inheritance that you received in that year could be assessed against you. So, if you got $1 million of gifts in 1 year and you don't do the 3520, they could hit you with as high as a $350,000 penalty. So, if you're sitting here watching this video thinking you got a problem, let's talk about your options to fix it, to get back in compliance with your foreign income and offshore information reporting requirements. Your first option is do nothing. This is a horrible idea, and I will explain to you why a little later on. Your second option is to get in compliance on a go-forward basis. This is also a terrible idea, and I'll explain why. Your third option, an option a lot of CPAs are throwing around these days, and a lot of tax attorneys unfortunately are throwing around these days, is to make a quiet disclosure. In my opinion, this can also be a terrible idea depending on your facts and circumstances. I'll explain why in a minute. Your fourth option is making a loud disclosure. In other words, entering into the 2014 OVDP program, Offshore Voluntary Disclosure Program. This is the only option that I recommend if there are significant badges of fraud in your fact pattern, because this is the only option that comes with a guaranteed amnesty or a pass on criminal prosecution, even if you openly admit that you were cheating. That was the whole reason you weren't reporting. Even if you openly admitted to it, you're going to get a pass on criminal prosecution or an amnesty. The fifth option is the one that everybody is super excited with these days. This is the one that almost every CPA on the planet is recommending. The wiser ones are sending their clients out the door without even talking to them to an attorney first to do what's called a willfulness determination before you enter a client into a streamlined voluntary disclosure. This is dangerous. I'll explain why. I've used them myself, but very seldomly and in the proper circumstances. To me, the deciding factor in going streamlined is, did you use a professional tax preparer in any of the last 3 tax years? If you did, that professional tax preparer would have asked you whether you had foreign accounts. If you told him no, and it was not reported on that tax return, that is enough of a badge of fraud for you to need the offshore voluntary disclosure program, and Streamline is not an option. The clients that I have taken Streamline have a history of always preparing their own tax returns. The last option available to you is only available to you if all of the foreign income has been picked up and all you're missing is the foreign information returns. If that's your situation, it's possible to file these foreign information returns even though they're delinquent and attach a penalty abatement letter to it and not pay any foreign account reporting penalties. I've done this myself successfully many times. This isn't something you should decide to do on your own without counsel. Okay, let's go through the do nothing option. If you're considering the do nothing option, it's a patently horrible idea. What you're in essence doing is you're gambling that the US government doesn't have the resources to identify the non-filing of the FBAR and the non-reporting of the foreign income. You're also banking that the US government doesn't have the ability to identify your offshore assets that are generating income, like your real estate or your offshore business. This is a grave mistake. Every participant in the 2009, 2011, and 2012 offshore voluntary disclosure programs has provided intel on the banks that were harboring their offshore accounts, the advisors who told them to put the money there, both domestically and offshore, and the government is using data mining to go through all of this intel to identify your offshore non-compliance. There's a witch hunt going on right now for any promoter of offshore income tax evasion. I have seen several CPAs and attorneys get criminally charged over this issue in recent years. Moreover, the FACTA information exchange is now open. Under FACTA, any offshore bank is required to report to the US government electronically if you have an account balance with them offshore under certain circumstances. The US government, in exchange for this information, is providing the same information on foreigners that have deposits of money here in the United States. All of this information is being traded between countries electronically through databases. It is expected that the IRS will be data mining the FACTA data exchange, trying to identify people that have offshore accounts that aren't disclosing them, including offshore sources of income that aren't disclosing them. You also have exposure if the US government opens up a criminal investigation against a bank where you have a deposit, or the bank where you have an offshore deposit makes a deal, an amnesty deal with the US government over their own aiding and abetting of income tax evasion. If you have a deposit with an institution that comes under investigation and the US government learns of this before you go to them voluntarily, you don't qualify for any of these options. You will be audited and you potentially could be criminally prosecuted. The point to all of this is that the US government is tightening the noose on this issue. If you have undisclosed foreign sources of income and undisclosed foreign accounts, it's a matter of time before they find your undisclosed income by finding your undisclosed account. Once they find your account, they can ask for the activity taking place in that account. They can see the deposits of income, and they can pretty much figure out if you're committing offshore income tax evasion. Doing nothing is absolutely not an option in the face of the draconian penalty regime I already walked you through, both civilly and criminally. Moreover, the most important thing I can tell you, if the IRS can prove fraud, there is no statute of limitations for any return that you filed in the United States or any offshore, domestic, or any other type of evasion or information non-reporting. The statute is open to the dawn of time. The next option we're going to discuss is to get in compliance on a go-forward basis only. In other words, file correctly as to your offshore income this year, file correctly as to your offshore foreign reporting this year, your information reporting, and ignore anything that's happened in the past. I'm one of 24,000 dual practitioner attorney CPAs in the United States. I have people coming to me all the time that said their CPA said, just ignore this issue. You're not going to get busted for it. Let's just pick it up on a go-forward basis. To me, this is insanity. Once again, the advisor that tells you this is gambling on the fact that they believe the IRS doesn't have the ability to identify your past non-compliance. Let me tell you why that doesn't make any sense. Well, consider this. Consider the ease in the day and age of databases and data mining and computers, how easy the IRS could identify a large account that just pops up on the radar screen. Through my continuing education, it is my understanding that the Criminal Investigation Division of the IRS is doing just this as we speak. Imagine this, for example. John Smith reports for the very first time that he has $1.3 million on deposit with a financial institution in the Cayman Islands. Imagine you're an investigator that's been asked to look at this. What would you do? The first thing I would do is I would pull up the last 8 years of tax returns that John Smith has filed and look at their earning capability and what they reported in the way of net income each year. Where did the money come from? Was it from earnings that were just saved offshore? Well, if John Smith shows $50,000 of income for each year for the past 8 years, and he's got 4 kids in private college, he can't afford to save while he's paying those type of expenses. The next thing you might think is that John Smith may have inherited the money. Well, if it was a U.S. inheritance, there should be some trail to it through a 706, some sort of filing. If it's a foreign inheritance, there should have been a 3520. So you search those databases and you rule out that he got it from gifts or inheritances. It won't take you long to realize that there's something wrong with that large a deposit in a tax haven country, and that would lead to a possible criminal investigation. How about the option of making a quiet disclosure? Some advisors are proponents of quiet disclosures. This includes CPAs and attorneys. I'm not. Let me tell you why. First of all, a quiet disclosure is where you go back and you just file amended returns to pick up the foreign income that was omitted on your U.S. domestic returns. A quiet disclosure may even include going in and filing delinquent FBARs. It may not, depending on the advisor's advice. In a quiet disclosure, the Criminal Investigation Division of the IRS is not made specifically aware of the fact that you're correcting for non-compliance. Therefore, this type of disclosure does not qualify to be a voluntary disclosure and will not come with any type of amnesty for your tax crimes, which is really what you're after here. Anybody that goes with this option is banking on the fact that the IRS doesn't have the resources to identify your quiet disclosure, and again rolling the dice. This approach has many proponents. Why? Well, first of all, no penalties. You'll pay the additional tax you should have paid in the first place, and you'll pay interest back to the original filing date of the return. You probably won't even get charged with a 20% negligence penalty, and there'll be no FBAR penalty. So I get how attractive an option it is. The reason I'm not a proponent of this approach, and let me say this very emphatically because I've seen this with my own eyes. At the ABA Crim Tax seminar that I go to every year, the highest people in the government out of the tax division of the U.S. Department of Justice have stood up and said, we will take a quiet disclosure as an additional badge of fraud as to the offshore activity, and we will criminally prosecute those we catch making quiet disclosures. This is why a quiet disclosure is a horrible idea. In my opinion, quiet disclosures would be very easy for the IRS to discover. Imagine in the day and age of computers and data mining, all you look for is amended returns with foreign source income popping up for the first time. Here's the pattern I'd be looking for. You have a current year return that properly reports for the first time offshore foreign sources of income. Then you receive 2 or more amended returns where foreign income pops up for the first time. You could set a computer to look for that pattern and pop every single one of these folks. Additionally, the IRS may receive a timely FBAR for the first time and 2 years of delinquent FBARs. All the IRS has to do is look for this pattern to identify people making quiet disclosures. My 19-year-old son could program that for them. If you're watching this video and it's making you very nervous because you've done a quiet disclosure, it's not too late. If we get to the government before they discover it, you'll still get an amnesty, a pass on criminal prosecution. You need to come see me or someone like me that handles offshore voluntary disclosures. Now let's discuss the safest option if there are significant badges of fraud in your fact pattern. It's called allowed disclosure or entering into the 2014 OVDP program. Granted, I will admit right off the bat, this is the option that will cost you the most money, both in legal and accounting fees and in penalties to the U.S. government. but is the only option that comes with a guaranteed amnesty for any crimes that you may have committed, provided you comply with the terms of the program. The first thing I need to tell you about this program is that don't think you can enter this program and only fix your offshore income tax evasion if you've also cheated on your domestic tax filings. Any fraud that you've committed both in the U.S., domestically, and in a foreign sense has to be fixed within this program. If you don't comply with the following terms of this program, you won't get an amnesty, you won't pass go, you'll go straight to jail. Matter of fact, there are very few recorded cases in history where someone has made any type of a domestic or foreign offshore voluntary disclosure and gone to jail. The ones that have gone to jail cheated in the process of coming clean and didn't comply with the factors I'm about to discuss. First of all, only legal source income is capable of being cleansed for tax evasion in a domestic or foreign sense. Illegal source income is ineligible. In other words, illegal source income would be drug sales, money from being a hitman, money from being a prostitute, money from extortion. The next requirement is that your voluntary disclosure has to be timely. By being timely, you have to beat the U.S. government to the punch. The moment they open up a criminal investigation against you or they open up an audit, you do not qualify for this program. Theoretically, you also don't qualify if the government has received information from a third party as to your noncompliance. This would be information obtained by search warrant, grand jury investigation, whistleblowers, any type of information, foreign banks through the data exchange, any type of information on you that they have on you that says your hands are dirty before you approach them. Theoretically, you don't qualify for the program. This doesn't mean they won't accept you into the program. Truthfulness. Your voluntary disclosure must be truthful in all respects. Completeness. This is where you'll burn down. If you only decide to tell them about the foreign bank you know is under investigation, but you don't tell them about the rest of foreign accounts, or your foreign real estate, or your foreign business, you'll go to jail. Also, completeness means if you have domestic noncompliance, you got to fix it at the same time you fix your foreign noncompliance. The last requirement is cooperation. You must cooperate with the government in determining what the true liability should have looked like in each of the years at issue had you filed a true, accurate, complete tax return. And then you must make payment of the tax, penalties, and interest that you agree to under the program terms, which we're going to discuss next. The first step in making an offshore voluntary disclosure is to apply and obtain a pre-clearance. The process begins where I collect your birth date, your social security number, your address, the correct spelling of your name. I include it on a fax and I send that fax off to the intake unit of the Criminal Investigation Division. Let me explain to you that this is a one-way trip. The moment you send off that fax, you have stuck your head out of your foxhole and your exposure for criminal prosecution goes up exponentially if you change your mind. You cannot enter this program unless you intend to see it through to the end. For that reason, this program should not be entered without the assistance of anybody but a qualified criminal tax attorney that understands international tax law and compliance. Again, the reason you want to do this step is the moment you send off that pre-check, it's like you're standing on first base in baseball. You can't be thrown out. You're safe. If the next day the Criminal Investigation Division knocks on your door after you've applied for this program because you have offshore noncompliance issues, you're still safe. This is important because the government is obtaining information on offshore noncompliance in a multitude of ways. John Doe summonses, treaty requests between two countries, an investigation of a foreign bank or a facilitator, either domestic or foreign. Any of this type of information can make you non-qualified for this program. The clock is ticking. Also, if a taxpayer through counsel or through their own efforts makes any attempt to block the providing of information from a foreign financial institution or any type of an offshore entity to the U.S. government, you are ineligible for this program. The next step in this process is to supply an offshore voluntary disclosure package. Let me tell you that the government has made this the Full Employment Act for attorneys and accountants. The average voluntary disclosure is a stack of paperwork this thick. I kid you not. The government gives you 90 days from your acceptance into the voluntary disclosure program to complete this package. Additional extensions of time are possible, but not without strings attached. Under this program, you're required to amend 8 years of income taxes to correct any domestic or foreign income tax reporting problems or any omitted foreign information reporting problems. You're going to be responsible for the federal and state income tax due on these amended returns, and for federal purposes, you'll be responsible for a 20% negligence penalty. Each state has additional penalties that may apply. In addition, you'll be required to file 8 years of FBARs and 8 years of foreign information returns. Upon submission of your offshore voluntary disclosure package to the federal government, typically 9 checks will be due. 1 for each tax year that includes the tax, penalties, and interest that applies to that year, and 1 for the foreign bank account reporting penalty. If any of your offshore investments were what the government considers offshore mutual funds, the PFIC regulations will have to be complied with. Luckily, in the OVDP, the government gives a condensed set of regulations, a simplified set of regulations for foreign mutual fund reporting. Basically, what we're required to do is to mark those assets to market each year and record the gains and losses on an annual basis. Let me tell you, if you have foreign mutual funds, you need a pretty sophisticated tax person to figure these out. We deal with them all the time. And the last thing I need to tell you is that the offshore folks that are running these programs have no discretion to bargain lower penalties, interest, and penalties than the program calls for at the outset. You agree to these program terms when you enter the program. There will be no bargaining lower amounts later unless you're willing to opt out of the program altogether, which is another option that we'll discuss. Here's why most clients and most advisors will look to any other option to deal with their offshore problems rather than the OVDP. The most expensive part is the FBAR penalty, which on the low end is 27.5% of the high water mark of your foreign accounts and possibly your foreign tainted assets over an 8-year period. What do I mean by the high water mark? If you valued all of your foreign accounts, an example would be you have one account that has $30,000 in it on average for an 8-year period, and for 2 seconds that balance shot up to $1 million. They would penalize you on the 2 seconds it was at $1 million, not the average of $30,000. What I mean by tainted assets is that any asset that you have offshore where you have underreported or non-reported the gross income off that asset. Notice I'm saying gross income, not net income, the gross income. So you have foreign real estate, for an example. You rent it out at $50,000 a year. Even if your expenses are $75,000 a year and you have a net loss of $25,000, because you didn't report the gross revenue of $50,000, it's included in the penalty base. So in other words, the aggregate highest account balance of your undisclosed offshore accounts and the fair market value of any tainted foreign assets are included in the FBAR penalty calculation. The penalty can be as high as 50%. If you have just $5 in a 50% bank, and I'll explain what that is in a second, and $5 million in non-tainted banks, all of your offshore bank accounts, financial accounts, and tainted foreign assets will be penalized at 50% because of the $5 in that tainted bank. The reason for this is either the bank that you have $5 on deposit with is under criminal investigation and they are of the opinion that they would have identified you whether you entered this program or not, or the bank entered into its own deal with the U.S. government to get amnesty for its own tax crimes. Again, the U.S. government feels that eventually they would have identified you as a target, therefore you pay 50% rather than 27.5%. This list is ever expanding. In the past 4 months, about 30 banks have been added to this list. This is a reason why the longer you wait, the more expensive this proposition could be for you. Not to mention, you may be identified as a criminal target and this program won't be available to you if you wait too long. The keywords to search the IRS website under are foreign financial institutions or facilitators. That list shall come up, and you can see if your bank is on that list. Again, there's exposure because of the FACTA legislation and the electronic data exchange that now exists and is in full effect. Don't delay. If you need to make an offshore voluntary disclosure, do it sooner rather than later. The government has also indicated that they might raise the 27.5% percentage at any point to a higher percentage. This data exchange results in a situation where any bank in the world can send in information to the IRS about you electronically through this computerized data exchange in a matter of seconds. Once the information from the FACTA exchange is used to identify you as a criminal target or even an audit target, at that point you're no longer eligible for the OVDP. Bottom line is, get to the IRS if you have this problem before they get to you. To further drive home what I mean by a tainted offshore asset, I'll read you a passage verbatim. The offshore penalty is intended to apply to all of the taxpayer's offshore holdings that are related in any way to tax non-compliance, regardless of the form of the taxpayer's ownership or the character of the asset. These are the OVD penalty assets. The 50% penalty will apply in any situation where a foreign financial institution has been identified as a facilitator of offshore income tax evasion, or any promoter, whether domestic or foreign, has been identified for criminal investigation or is cooperating with the IRS in exchange for amnesty. If they're identified and you're associated, it's a 50% penalty once you come in the program, if you're even allowed into the program. The simple use of a John Doe summons to your banking institution can result in you paying a 50% penalty rather than a 27.5% penalty. A John Doe summons basically says, anybody that's a U.S. taxpayer that has a deposit with your institution, we want information on them. Again, once the 50% penalty applies to any portion of your offshore assets or accounts, no matter how minute, the 50% penalty goes to all of those assets, not just the tainted asset. What a lot of my clients have found patently unfair and even outrageous is that no amount of offshore income is excludable as de minimis offshore income tax evasion. Even $1 of omitted foreign income is sufficient to withstand a penalty under this program. Said another way, even $1 of unreported gross income from an OVDP asset will cause that asset to be included in the offshore penalty base. Moreover, there's been situations where you've got $5 of interest income, $50 worth of account fees, you had a net economic loss. Since only the gross income is looked at for purposes of this rule, it can be included in the penalty base even where you lost money. What some tax attorneys are doing is they're looking at people that have entered into the offshore voluntary disclosure program and doing opt-outs with them. Caution if you're considering an OVDP opt-out. Okay, let me explain what that entails. In situations where you believe that the offshore penalties are completely out of proportion with your culpable behavior, you may want to consider an opt-out. This is very dangerous. Let me explain why. An opt-out is basically a decision to remove yourself from the 2014 OVDP program and subject yourself to a standard civil audit on all of the domestic and offshore income tax issues and the information reporting that exists in your fact pattern. While you will maintain a pass on criminal prosecution if you've done everything right and you've complied with the terms of the OVDP, all available civil penalties can be asserted against you that exist in that situation. In the opt-outs that I've considered in my own practice, where clients have come to me and said, would an opt-out work for me? What I always do is I approach the auditor that's processing the OVDP and I ask the hypothetical question, if my client opted out, what type of penalties would they be looking at if they opted out of the OVDP? Invariably, in every instance where I asked that question, what I got back is that they would pay more penalties, taxes, and interest if they opted out of the program than if they stayed in. The reason for this is the government has already invested lots of time and energy in processing the OVDP. They've audited the submission to the OVDP. They're invested in the penalties that you agreed to pay when you entered the program, and they want to find a way to pressure people to stay within the program. For this reason, I don't favor opt-outs, but I'm willing to consider them. Another option available to you to consider is the making of a streamlined voluntary disclosure. Caution, caution, caution. There are a lot of CPAs that have jumped in on the bandwagon to fix foreign non-compliance. A lot of them are saying, don't go see an attorney. I can handle your problems. Talk to me about it. And if you don't go see an attorney to determine whether you were willful and how many badges of fraud are apparent in your fact pattern and how likely you are to go to jail if you enter yourself into this program, then you're a fool. It is my prediction that sooner or later, somebody that has entered into the streamlined voluntary disclosure practice that shouldn't have, that was willful in their behavior, will go to jail, and quite possibly the advisor that put them in that program, knowing that they were willful in what they did and took them through that program, will go to jail with them. So what's involved with a willfulness determination? To get through a streamlined voluntary disclosure, you have to make a representation to the government that your foreign non-compliance was related to something other than willful conduct. The actions you took weren't to avoid U.S. income taxes and to sideskirt the U.S. information reporting regime. What I look for in making the willful determination are something called badges of fraud. These are circumstances that, when viewed by the government, will make your actions look criminal, no matter what you say your intent was. Here's an example of a badge of fraud. If you had money in an institution that came under criminal investigation, let's use UBS for example. If you had money with UBS and you transferred it to some bank in Zimbabwe, thinking that that bank won't come under criminal investigation, trying to get your money out of the bank that's under criminal investigation, that's a very damning badge of fraud. If you took actions to get the money out of your name, you transferred it to an offshore relative, an offshore friend, and you still have control and dominion over that cash, that's a badge of fraud that can hang you. If you wired money from a foreign banking institution into your U.S. domestic accounts, trying to avoid disclosure of that money, that's a damning badge of fraud. This one's terrible, and I've seen it time and time again. If you started withdrawing money and bringing it back from a foreign banking institution in increments of less than $10,000 at a time, and you brought it back in cash, that's a very damning set of badges of fraud, especially where you did this multiple times. If you've been using a tax professional for the past, I'd say 4 years, and you've been consistently omitting foreign sources of income, not filing the FBAR, every advisor in America has been sensitized to this issue and taught if you don't ask about foreign bank accounts, if you don't ask about foreign source income in every tax interview, you're in violation of Circular 230, your right to practice in front of the IRS can be revoked. For this reason, most CPAs have clauses in their engagement letter that says, we routinely ask about this information. If it doesn't wind up being reported, it's because you didn't tell us about it. There was a new form brought into existence called Form 8938. Anytime you have assets in excess of $50,000 in a foreign jurisdiction, you have to report that. If you consistently didn't report these assets and you used a U.S. tax preparer, those are damning facts. If you use a U.S. tax preparer and you routinely failed to report foreign sources of business income, even if you had self-prepared returns and you took some of these actions, those are very, very damning facts, and in my opinion, cut off the availability of the Streamlined Voluntary Disclosure Program as an option to you. If you routinely failed to report foreign rental income, that's a very damning set of facts. If you had an inheritance of over $100,000 and you didn't do a Form 3520, that's a very damning set of facts. If you routinely failed to file Form 5471, 5472, these are damning facts. Oh, and this one is a killer. If you received a letter from a foreign bank telling you that they were about to report your information to the US government, and you go streamlined, that can be very problematic. Especially if you received that letter 3 years ago and you've still failed to report the existence of that account and the existence of that foreign income. Worse yet, where you had a preparer preparing that return. Think about it, you go streamlined. The IRS auditor decides to call your preparer that you use for the last 3 years, especially if they're the ones that have amended your return to include the foreign income. And they say, "Hey, CPA Smith, did you ask this client about foreign sources of income over the last 3 years?" Now they're really in a dilemma. They may want to protect you, but they have to protect their right to practice against the IRS and show that they met their due diligence procedures. Well, they're going to show them the clause in their engagement letter that says they asked about it every year. They may show them an organizer that says they asked the questions every year and your answers to those questions. And frankly, that preparer is kryptonite for you. They don't have attorney-client privilege. They could be forced to testify against you. They'll be government witness number one. If you have foreign non-compliance problems, do not take it to your original preparer. So to reiterate, there are certain fact patterns that if they exist in your background, in my opinion, you don't qualify to go streamlined and you're asking for it. You're asking to be criminally prosecuted. Again, there is no amnesty associated with streamline. If you committed crimes, and these are indications of crimes that you committed, you acted willfully, not non-willfully, you can get criminally prosecuted if you go through this door. Do not make a decision to go streamline without talking to a reputable tax attorney that knows this area of law very well first. If you're not impressed with me, call me. I know lots I can refer you to. Here's a common fact pattern that's very, very damning, and I wouldn't go streamline. At some point in the past, you had an offshore inheritance that was over $100,000 in value. You didn't do a 3520. You kept the assets offshore, whether that be foreign rentals, real estate, whether that be a foreign operating business, whether that be investments in the foreign market. You didn't report that income for a 3-year period of time. You didn't do any of the information reporting. You didn't give them the FBAR. Don't go streamline. The government knows that a lot of people chose to not report their inheritance because they were afraid of paying U.S. estate taxes. The ironic part, if you saw someone like me, I could tell you how you could legally receive an inheritance or a gift from a foreign source and pay no U.S. transfer taxes or estate taxes on that legally. It was your actions to hide that source of inheritance or wealth from the U.S. government that caused the problem in the first place. Here's a fact pattern I've seen time and time again that I wouldn't take streamline. A lot of people come into the U.S. to get an education. All right, they get an education here, then they spend a couple of years working here, then they leave and go back to where they came from, having a green card and start an offshore business. You may be able to get away with streamline if you can prove that you didn't understand that what you were doing was committing income tax evasion when you left the United States. But worldwide income is reportable when you have a green card, no matter where in the world you earn it. If you haven't reported the profits off an offshore business and you haven't done the FBAR filing, that could look like a motivation to commit income tax evasion, so you didn't file the FBAR. Both are criminal acts. Here's a fact pattern I've seen a couple times. If this is your fact pattern, you better not go streamline. Some overly aggressive tax advisor in the United States may have told you to conduct yourself in the following manner. Form a non-controlled foreign corporation. You own less than 51% of the stock. 49% would do it. Your butler, your maid, your driver owns the rest of the stock. The only problem is they don't know about it because you put the stock in their name and you never told them about it. That is a sham foreign corporation, a sham non-controlled foreign corporation. The idea is to get a permanent deferral from U.S. taxation by only having to report income in the United States when dividends are repatriated to the United States. What a great tax saving mechanism. Unfortunately, completely illegal. If that's your fact pattern, you better not go streamline. You better come see someone like me to clean it up. Especially when all information reporting is missing and none of the foreign income got reported. If you've engaged in massive amounts of offshore real estate development, you go down there and you start developing raw land into apartments. Then you start renting the apartments. You don't report the rental income. Then you start selling the apartments and buying bigger plots of land. You don't report the capital gains on the investment in the real estate. You don't do any of the information reporting. You don't report any of the income. It's very hard for you to stand in front of the U.S. government and say, I acted non-willfully. I didn't know all of this was illegal. It's a hard sell, okay? Don't go streamlined without talking to me. Also, if you inherited large amounts of rental real estate offshore and you didn't report the income and you didn't do a 3520 and you didn't do any of the information reporting, don't go streamlined. Come see me. You need a 2014 OVDP to get a pass on criminal prosecution. Here are some more fact patterns that I would think twice about taking through someone streamlined over, especially where they had a U.S. tax preparer for the past 3-4 years. If there was an unreported stream of foreign pension payments or anything akin to U.S. Social Security, some sort of social support payment that was taxable in the United States, that didn't get reported in the United States, that none of the information reporting got done, and you accumulated all of that in an offshore account that wasn't reported, I wouldn't go streamlined. Come see me. Another hidden issue that only sophisticated folks in this arena understand is that foreign pension plans can create other problems. One, only US-based pension plans get to accumulate income on an annual basis in a non-taxable fashion. What basically a retirement plan is a bunch of invested assets in a market of some sort. The interest income thrown off from that, the dividends thrown off from that, and the capital gains from that are non-taxed because pension plans get a special exclusion from current year recognition of income. Your offshore pension plan may not get the same treatment and usually doesn't. Under the law, an offshore pension plan is ordinarily treated as an offshore grantor trust, of which the income, even if not distributed to you, that develops on an annual basis is currently taxable to you. The known exceptions to pension-like or retirement-like arrangements offshore that escape current year taxation are the following. If there is a totalization agreement between the United States and the foreign country, and the offshore program is something akin to U.S. Social Security, that can accumulate offshore without current taxability. The other exceptions are Canadian Registered Retirement Savings Accounts, RRSPs, and RRIFs. If you make an election to defer taxation on those retirement plans until retirement on a Form 8891, and you make a declaration under penalties of perjury as to the causation of your non-filing of this form at an earlier date, these amounts will not be currently taxed to you as the income accumulates on an annual basis, and they will not be included in an offshore penalty base. In other words, won't be subjected to 27.5% penalty or the 50% penalty. If you get nothing out of this video and you're considering a streamline, consider this. In order to go streamline, you have to make a certification of non-willfulness. What's basically involved with this certification of non-willfulness is that under penalties of perjury, you have to make a statement to the U.S. government that the non-reporting of income, the non-filing of foreign information reporting, was caused by something other than willful intent to evade income tax. What's really scary here is if you're talking to a CPA, CPAs are not trained in criminal tax procedure or in how to gauge your conduct on a scale between negligence, criminal negligence, or willful intent to violate tax law. They're not trained in criminal tax procedure. Matter of fact, most professionals aren't. I happen to be. What I have to drive home here is that your idea of what willful means and the government's idea of what willful means is completely different. And what most CPAs believe is willful is completely different. The bar for willfulness has been lowered in the offshore account compliance area. I'll explain what that means in a minute. But for now, what I need you to understand, if you certify that your actions are non-willful and the IRS later on determines that your actions were willful, no amnesty for a streamline, and they will criminally prosecute you. Not only will they criminally prosecute you, you will be subject to all available civil penalties as well, including all those nasty things I told you about earlier in this video that they can do to you civilly, without even going after you criminally. What I really need to drill home here is that a simple claim of ignorance as to these foreign income tax and information reporting laws is insufficient to support a claim of non-willfulness. The bar has been lowered in this area. Let me explain. Here's some really scary case law if you really understand the law here. In U.S. versus Williams, it was held that a simple effort not to learn about the income tax compliance and foreign information reporting requirements applicable to your situation is sufficient to make you willful as to income tax evasion and willful non-information reporting. Making a conscious effort not to learn about the law, not to educate yourself, is willful behavior in this area of the law. What you need to understand, in Williams, the Fourth Circuit was focusing on the overall actions of the taxpayer to avoid income taxes. Willfulness can also be established via inference by looking at a taxpayer's actions. Any conduct intended to conceal or mislead foreign sources of income can establish willfulness. That, in addition, it can be inferred from somebody's conscious effort to avoid learning about the reporting requirements will establish willful conduct. I've said it before, if you've been using a tax professional for the past 4 years, you should really think twice about Streamline. Can you imagine your preparer being asked questions like this? Did you ask your clients, as you're required to, under Circular 230, about foreign income and foreign income generating assets and foreign accounts? Did your organizer talk about these items? Did your engagement letter speak to these items? If your preparer gets asked these type of questions, they immediately have a conflict of interest with you. If your CPA wants to maintain their licenses and maintain their right to practice in front of the IRS, they have to be able to prove they met their Circular 230 due diligence requirements in preparing returns, and they had to ask about these issues. Again, your tax preparer has no attorney-client privilege. They can become government witness number one against you. They can be forced to testify even if they don't want to. If you lied to your preparer and the government figures this out through interviewing them, this will expose you to all of the criminal and civil sanctions available to the government at their disposal, because that's a willful act. So, here's the bottom line. Do not be penny wise and pound foolish and go streamline when the 2014 OVDP is your only logical but expensive option. Do not make a willfulness determination on your own. Do not make that determination without the aid of somebody who's trained in this issue, like myself or somebody I could recommend. Do not rely on anybody other than a seasoned criminal tax defense attorney, as willfulness in this area emanates from all the existing case law that has developed since UBS blew up. Again, willfulness emanates from all the underlying criminal tax law in existence to date. Only attorneys are capable of making a willfulness determination, and you don't want to discuss this issue with the original preparer or anybody that doesn't have attorney-client privilege. I don't care what they promise you. Don't trust the original preparer. They will burn you to save themselves if they have to. Now let's get to why so many people prefer Streamline. It's cheaper. Here's what's involved. First of all, the Streamline is available to U.S. taxpayers domiciled in the United States or expats offshore. It's available if the IRS has not opened an audit. It requires 3 years of amended tax returns and 6 years worth of FBARs. That's a lot better than 8 years of amended returns and 8 years of FBARs. You'll pay a 5% penalty if you're a U.S. domiciled taxpayer, and you could potentially pay a 0% penalty in specific circumstances if you're an expat. Expats must meet a residency test for 3 years to qualify for a Streamline. This basically requires them to have no U.S. abode and to have spent 330 days of each tax year offshore. Again, if you qualify, there'll be no FBAR penalty. Let me just say this, there will be tax liability in most cases if you haven't filed in the U.S. Think about this, if you're in a country that doesn't have a totalization agreement with the United States, that means any income you earn offshore that's even excluded from taxability under the foreign earned income exclusion is still subjected to self-employment taxes in the United States, which can be 12.5% of your offshore compensation. Additionally, If the offshore tax rate is lower than the U.S. tax rate, you at least owe the differential between the foreign rate and the U.S. rate, even with the benefit of the foreign tax credit. Meaning, if you're in England and they have a 20% tax rate and the United States would have been a 30% tax rate, you'll pay 20% tax to England and 10% tax to the United States. So what are the takeaways from this video? To protect yourself, only discuss your foreign non-compliance issues with an attorney. Only an attorney can guarantee you attorney-client privilege. An attorney that also happens to be a CPA with a master's degree in taxation and understands all of the foreign compliance requirements from the ground up, from the accounting to the return to the information returns, is a good choice. That's me. And what you must understand is any offshore non-compliance can be potentially viewed as criminal activity. So what's our value proposition here as a firm? This practice area that I've discussed over this entire time on this tape has represented at times up to 60% of my entire book of business over the last 7 years. We can handle both the legal and the tax aspects, tax compliance, information reporting aspects of your case under one roof, which brings you economies of scale. You don't have to hire one attorney and one CPA firm to deal with this problem and pay them to talk to each other. Matter of fact, that's how most of them are getting work. They're referring it back and forth amongst each other. I'm reaching out to you directly. Granted, if my firm prepares tax returns, especially if I sign them, there's no attorney-client privilege for any of the discussions. But I can tell you this, if we move forward and we submit an offshore voluntary disclosure or we submit a streamlined, I've explained everything to you. You will have waived your attorney-client privilege, and I will present you the opportunity to work with any CPA firm you want on the planet if you so choose. I will let the decision be yours, not mine, and I will explain the risk in using my firm and the benefits of using my firm for all pieces of this. The decision is yours. We are a very experienced and reputable international tax compliance and controversy law firm, and we have all the functionality of a CPA firm outside of the attest function. If a problem develops in your offshore voluntary disclosure, we have handled many cases that were criminal from the get-go, and nobody we have ever represented in an offshore compliance scenario has gone to jail yet. Our pricing structure is not only efficient where we do everything in-house, our prices are comparable to most quality CPA firms and on average lower than most of our deemed law firm competitors. The value proposition that we compete on in this area is our level of service, our experience, the advanced education found in my firm. Most CPAs have master's degrees in tax, most attorneys have LLMs. I myself have a master's degree in tax, I'm a CPA and I'm an attorney. Lastly, affordability, and we provide value for our representation. Thank you very much for watching this video.
Thank you so much again for your time and interest in how we may be able to help you. Please don't hesitate to call if something is worrying you. We would be very happy to help. Just call or email for a reduced rate consultation.